Assalamualaikum. Hi. For this video, I will explain about money, banking, and financial system, and I will focus more on financial system in Malaysia, central bank, and also monetary policy. Okay. Now we move to financial system in Malaysia. Okay, the financial system in Malaysia divided into three. The first one is banking institution. For banking institution, there are two types. The first one, central bank. For Malaysia, our central bank is Bank Negara Malaysia. The second one is commercial bank. Commercial bank, or we can say the private bank. For example, Maybank, CIMB, Hong Leong Bank, Public Bank. All those things are commercial bank. Okay, that for banking institution. For non-bank financial institution, including finance companies, Islamic banks, merchant banks, and discount houses. And for non-bank financial intermediaries, divided into two, development financial institution, for example, bank BSN, Bank Simpanan Nasional, Agrobank, and for EPF, KWSP, including in non-bank financial intermediaries. Okay. Next is for central bank. Okay, what is the difference between central bank and commercial bank? Central bank is the main bank in the in Malaysia, for example, Bank Negara Malaysia. Okay, the central bank is an important financial institution in every country and plays active role in implementing government's economic policy. There are several functions of central bank. The first one is central bank will issue and manage the country's currency to ensure currency stability. And printing of paper money is one of the most important function of a central bank. In Malaysia, Bank Negara Malaysia is the only financial institution with the authority to issue and manage currency to ensure currency uniformity and stability. The second one is the banker and financial advisor to the government. Central bank acts as a banker and financial advisor. Central bank will keep the government's principal bank account, receive tax and other revenues, and makes payment in respect of the government expenditure. The central bank makes short-term advances to the government, manages the national debt, sells bond, and redeems matured treasury bill. Okay, that is the second function, banker and financial advisor to the government. Next, central bank also overseeing monetary policy. Bank Negara supervise money market operation to ensure low inflation and full employment through managing interest rate and setting the reserve requirement. Low inflation creates greater economic stability and preserve the value of money and savings. Next is central bank as a holder of the country's stock of gold and forex, foreign currency reserve, and banker to other banks. Central bank keeps cash reserve of commercial bank and act as the custodian of the cash reserve to support credit and banking system. Banks also keep their deposit with the central bank, and central bank also as a lender of last resort to commercial bank and government. If bank gets into liquidity shortage during financial crisis, central bank will lend the commercial bank sufficient fund to maintain public confidence in the banking system. The central bank also acts as lender of last resort to the government Government borrowing is financed by selling bond in the open market. If government fails to sell sufficient bond and has a shortfall, the central bank will buy some government bond to avoid liquidity shortage and public panic. Okay, so that's all the among the functions, the main functions of the central bank. Now we move to monetary policy. What is monetary policy? Monetary policy is one of the policy that will be implemented in order to meet the macroeconomic objective. Okay, so for monetary policy, there are two types, expansionary and contractionary policy. For expansionary policy, usually we use to control unemployment during a recession. Expansionary policy aims to increase money supply in the economy. It will cause money supply to shift rightwards, leading to an increase in real GDP and hence lowering unemployment rate. For contractionary policy usually we use to reduce inflation, to control inflation. And these types of policy aims to decrease money supply and will cause money supply to shift leftwards, leading to a decrease in real GDP and hence lowering the inflation rate. Okay, so government will employ central bank to implement monetary policy. Which type of monetary policy depends on the current economic situation. Okay, there are several tools to control the economy. Okay, the first one is open market operation. Okay, open market operation refer to the central bank buy or sell the government securities or treasury bills in the open market to influence the size of bank deposit. Okay, so here central bank, bank negara will sell or buy government securities or T-bills in the open market to influence the size of bank deposit. When the price are rising, okay, inflation problem happen. So the government need to control the price to keep increase. What should they do to control this? Here, for monetary policy, they will implement contractionary monetary policy. Central bank will sell securities and treasury bills to the public. Okay, individual, firm, and commercial bank will purchase these securities, and hence it reduce bank deposit. Okay, do you understand here? Individual, firm, and commercial bank will purchase these securities, hence it reduce bank deposit. The reserve and credit creation of commercial bank. Okay, when central bank sell the securities, we as a buyer, as a public, as a commercial bank will buy those securities or T-bills. Therefore, our money will be reduced, right? And money in the commercial bank, for example, CIMB, Maybank, Hong Leong, they will reduce because of they buy the securities. The cash reserve in their bank will be reduced. So here, commercial bank lend less to the business community. If someone want to make loan or borrowing from the commercial bank, from Maybank or CIMB or Hong Leong public bank, they cannot give you the loan because their money reducing, and money supply will drop. Interest rate will increase. Investment will decrease. Okay, because of less money, interest rate automatically will increase and investment will reduce because interest rate is the cost of borrowing for investment, leading to a decrease in aggregate demand. Okay, in the market, aggregate demand and aggregate supply, when aggregate demand decrease, aggregate demand will shift to the left and the will uh, price will reduce. Automatically, inflation rate will be solved. Okay, for recession, during recession or during the times that unemployment would be higher, unemployment rate higher, um, expansionary policy will be implemented. How? Okay, central bank will buy securities from the public. Okay, paying them with check. Okay, central bank buy back all the securities from the public and commercial bank. So they will pay money to the commercial bank on or public. Check are paid into general public's deposit in the clearing banks. The reserve of commercial banks are raised and banks can lend more, resulting in an increase in credit creation and money supply, which lead to the fall of interest rate. Okay, this will result in an increase in aggregate demand, increase in investment, aggregate demand, and also will give open up more job opportunities. Therefore, the unemployment rate will be reduced. Okay, so this picture is the certificate of security treasury bills of um, England. I think this one England and Bank of England and also US. I cannot find any from Malaysia because I think it's a private and confidential. But these types of treasury bill or just one certificate that amount for this one is 1 million pound and for this one is 1 million US and 1 million USD. Yeah. Okay, so do you understand for open market operation? Open market operation is buying or selling. Central bank buy and sell the government securities in order to control money supply in the economy by buying and selling the government securities. Okay. Second, tools. How central bank control money supply in the economy. They will use required reserve ratio upon the bank. Okay, what is the reserve requirement? Reserve requirement is also called cash reserve ratio or statutory liquidity ratio. Okay, required reserve ratio is the minimum amount of cash that the central bank requires all commercial banks to keep in the central bank. Okay, minimum amount of cash that the central bank requires all commercial banks to keep in the central bank. It is to limit the amount of loans that bank can make to the domestic economy, thus limiting the supply of money. The higher the central bank set the reserve requirement, more fund the central commercial bank are required to keep with the central bank, and this reduce the fund that the commercial bank can lend out, lead to lower money creation and lower aggregate demand, and hence price level will decrease. However, during recession, the central bank reduced the required reserve ratio to encourage an expansion in lending and deposit. This will stimulate the economic activity and hence investment output and employment level will increase. This one, I think actually is quite a long time ago. During 2016, Bank Negara reduced Statutory reserve require SRR ratio from 4% to 3.5%. Okay, to ensure sufficient liquidity in domestic financial system. Okay, this is one of the example for SRR. Okay. Bank rate policy or discount rate. Bank rate or discount rate is the rate of interest which a central charges on loan and advance to a commercial bank. When a commercial bank, for example, Maybank, CIMB Public, Hong Leong, want to borrow amount of money from central bank, they will be charged on discount rate or bank rate. So based on monetary policy of the country, whenever commercial bank have a shortage of fund, they can borrow from the central bank via bank rate or discount rate. Changes in the bank rate or discount rate will cause changes in the market rate of interest rate, and this can affect the cost of loan borrowing. Okay, when inflationary pressures start emerging, the central bank will force the interest rate up by rising its own lending rate, and hence loans become costly to borrow and public spending reduces. This will reduce investment and aggregate demand, thus the price are checked from rising further. On the other hand, during recession, central bank will reduce the bank rate. Borrowing loan from commercial bank will be easier and cheaper, and this will boost up the credit creation, aggregate demand, and employment. Okay, this one is for the charges on loan made by commercial bank to a central bank. Fixed margin requirement is another tool to control the money supply in the economy. Margin requirement refers to proportion of the loan amount which is not financed by the bank. For example, the borrower has to raise the fund of the margin amount in order to get financing for this purpose. If the margin requirement is reduced, the loan size will be increased and vice versa. A reduced margin requirement will encourage loan borrowing, and this will increase the credit supply the needy sector. However, an increased margin requirement will discourage loan for other non-necessary sector. Okay, if the central bank feels that more credit supply should be allocated to needy sectors such as manufacturing sector, then it will reduce the margin requirement to as low as 10% to obtain loan from manufacturing sector. Hence, borrower only need to self-finance 10% to obtain loan, and this will encourage more loans to be borrowed. Okay, that's all for monetary policy tools. There are five. No, there are four tools here. I hope you guys will understand how central bank control the money supply, how central bank will solve the problem of inflation and unemployment. For example, now we have the stiff, quite difficult in the economy, and government use expansionary policy. Here now, the central bank reduce the SRR ratio and easy money policy to encourage people to spend more in order to stimulate economic growth. That's one of the example for the current during COVID-19. Okay, so that's all for now. Later, I will record one more video for commercial bank and also credit creation policy process. Okay, thank you. That's all. Bye.